Hello and welcome. You're watching Business Today Television. I'm Tanya, Aneja. Well, FY23 was a year of consolidation for markets globally as well as in India against the backdrop of the Russia-Ukraine war and the sharp rate hikes by central banks. But where are the markets headed in FY24? And how should one pick multi-bagger stocks amid volatile markets? To discuss this and much more, let's welcome our guest on the show today. We have with us Mr. Jaspreet Singh Arora. He is the Chief Investment Officer at Research and Ranking. Thank you so much, Mr. Arora, for taking the time out and joining us here on Business Today Television. And I want to begin by asking you about your FY24 market outlook only. FY23 was a volatile year, of course. So, where is the Indian market headed in FY24 according to you? And do you see any new challenges that the market is expected to face in this new financial year?
Yeah, hi, good morning to everyone, and thank you for inviting us. So, as we've seen that India still remains one of the fastest growing economies in the world, and IMF projects that this calendar year 2023, India could grow almost at 6%. The closest to that would be China at about 5%, and US, which is less than 1.5%. So that's a good part. Other things which are happening is, the inflationary concerns are easing, the commodity prices are cooling off.
Right.
So a large part of the macro overhangs that were there in the last 1 year, they are abating. But at the same time, the lingering impact of, the interest rate hikes and global slowdown, as we have seen recently in the IT results, that are taking a bit of a impact on some of the export heavy spaces, and they continue to remain some of the near term challenges, especially in the early part of FY24.
Okay, absolutely. And also now coming to multi-bagger stocks, because I think investors are always looking for stocks that provide returns that are several times the amount invested in them. So it is very important to now discuss the mantra to select these stocks, these multi-bagger stocks. So which strategies you follow and how to really, identify these multi-bagger stocks, especially in this kind of a market?
Sure. Yeah, that's a great question, and there's something that we kind of think in and out almost on a daily basis, especially, and it's been a very challenge in the last year and a half. But just to mention some of the points that we consider in the overall bagger framework is to look out for names which has a high earnings growth potential, and there's a little bit of element of valuation re-rating also available. While the other tailwinds that the sector is in momentum, or there is a restructuring, or there is a positive event, management change, all that will add to that compounding. But you cannot forecast that on day one. So you have to kind of leave that, for in terms of the luck or the chance element there. Some other points I would like to highlight is a stock which doubles every 3 years, which is a 26% compounding, is actually a 10x in 10 years. But the moment one loses patience, the big upside is not realized. So the key word is patience. Other things I would say, depending on the conviction level, one can start with a moderate exposure of about 2% and then increase it to maybe 3% and gradually more, depending on the conviction level in that space. And lastly, don't put too much pressure by expecting all stocks within the portfolio to turn out to be multi-baggers. Be realistic that at the end of the day, only some of them will turn out to be multi-baggers, right? And just keep on evaluating or revisiting that investment merit every year. That I would say would be some of the ways we would try to identify a multi-bagger framework.
Absolutely. I think it's a very important point that you made, and it's very important to be realistic in this kind of a market. And now, coming to the stocks that are available at a discount, at like good discount. So, are there any rules or strategies that an investor should follow? Because if you see after the recent correction that we have seen so far, many stocks have corrected significantly and are available at a very good discount. So how should one avoid catching a falling knife, and what should be the strategy?
So that's again a great question. So as everyone knows, that this journey is never a very smooth sail, right? It's almost like you have a ship in an ocean. Sometimes it's calm, sometimes it's turbulent, but you got to live through those turbulent times to see those calm times as well. So considering that there are periods of volatility, and there are opportunities that the investor will get, the larger idea should be to stick to the fundamentals and the potential earning growth while picking or as well as evaluating stocks. Some of the rules that we keep on harping on with investors is to ensure that one has adequate diversifications, be it sector, be it market cap, or be it on a risk basis. Let's say example, it could be on a beta basis, right? And avoid poor exposure to some individual name. Just because I'm very positive on a particular name doesn't mean I will one should go all out and put disproportionate money there. So at research and ranking, our philosophy is to cap it at 7%, irrespective of the conviction levels. Another thing I would try to bring out that we follow at research and ranking is to have a bucket where in that portfolio, you having some stocks where you are taking a 1 year view, some where you're taking a 3 year view, and some where you're taking a 5 year view. So what will happen is, let's say there is panic on the street, and one needs to press the exit button. I would then know, which stock I need to exit in case there is any liquidity or other reasons. Is it the category where I'm taking a 1 year view, and definitely not the category where I've taken a 5 year view. And obviously, 5 year view of stocks are the ones which are proven multi-baggers, have a very a solid base behind them, and there is a long-term structural sector tailwind as well. So these would be some of the ways one can look at to avoid that falling knife risk.
Okay, absolutely. That's the word coming in. And also, Mr. Arora, markets are in consolidation mode right now. I mean, it's a tug of war between bears and bulls. So, any hacks to manage the money or any mistakes that one should avoid, especially at this point in time?
I would say, the idea should be just investors are definitely showing courage, they're showing conviction, but where they fall short is on the patience part. So I would, really urge the investors to, given the way India growth story is expected to pan out, where we expect it to be a 5 trillion and ultimately a 10 trillion economy over the next 10 years, be mindful that these are temporary blips, and they can be a rewarding opportunities in the long term. Just to give you some statistics, when you look at the last 1 year, the Nifty return is just a paltry 4%, right? It's hardly anything. But 5 year and the 10 year period returns CAGR is about 12%, and on a 20 year basis is actually a very good 16%. So the moment one takes a long term approach, it things start falling in place. And I want to add another point here: just avoid that trap of this philosophy of buying at any price, right? It's just not proving it to be going right, especially in the last year or so, where one is buying any stock at any kind of valuation, and at the same time try and avoid stock which has fallen by 50-60% in the last 1 year. Just because it has fallen, there would be reasons why it has fallen. One needs to understand that and then take a individual case by case.
Okay, golden words coming in. And also now let's come to asset allocation part. So do you think equity is too risky for some investors now? So basically, how should investors with like moderate risk appetite maximize returns with lesser risk?
Okay, yeah, that's actually so we largely at research ranking, we largely kind of drink, eat, sleep on an equity, because that is the area we believe has been a proven compounder asset over the last a decade or so, including 2 decades. So equity is risky, but for investors who are coming with a quick gains expectations, the moment one understands one risk, what's the appetite, what's the suitable diversification approach, am I sticking to quality names, I think that risk gets significantly mitigated. And also to conclude, I think having a slightly longer term approach always helps. In current context, I would say have at least a 2 to 3 year view, if not more, just to ensure that the risk part is within tolerable limits.
Okay, absolutely. And now also let's talk about a space that is actually hogging all the limelight. So IT stocks are in focus and they are actually going through, I think, their worst phase in recent times, and lower than expected results by all these IT majors in the March quarter show that cracks are beginning to emerge, with the worst being ahead of us. So what are your thoughts on this particular space, and do you think this is a good time to pick some of these IT stocks?
So yeah, that's like the top of the town
Yeah.
currently, with a lot of mayhem and chatter which has happened in the last week or so, specifically after the results of the giants. So I would say the sentiments is definitely turned negative. Demand outlook remains weak, and this is all coming in from the outlook provided by the large cap IT companies. So they have, while there have not been any project cancellations, but the broad-based weaknesses across verticals, including BFSI, retail, high-tech, discretionary IT spending, that's been put on hold. And the damage is more in North America versus Europe. So I don't think that's too good a news. The Nifty IT index is down, was down 7-8% after the recent results,
Right.
and some of the stocks have hit 52-week low as well.
Right.
If you look at the last 1 year, the Nifty IT index is actually down 17%, while Nifty is up 4%. So that's a big gap between the Nifty IT and the benchmark. So overall, I would say the overall macroeconomic headwinds, challenges that are there may remain in the short term, and one would be better to pick quality IT names and not just go by pure valuations. To conclude, I would or we would be looking at an approach where currently we are underweight on the sector in IT, but the way we would approach is to move that underweight to equal weight over the next 2 to 3 quarters, and then take a fresh view whether one really needs to go overweight in the sector.
Okay, absolutely. So that was all about IT sector. But which are the sectors you are extremely bullish on, especially over the next 1 to 2 years? And which were the ones are you bearish on? And among sectors, where do you want to increase your exposure for FY24? I mean, any emerging themes that you are closely watching, especially at this point in time?
So that's again an area where we things are changing so rapidly, and one is kind of literally on their toes, right? So currently, at Research and Ranking, we are bullish on financials, we are bullish
Okay.
on consumer discretionary,
Okay.
manufacturing, and auto. This is where we would be overweight. We would be equal weight, I would say, on names on areas like building materials, FMCG, chemicals, and the spaces of IT and pharma. We would be moderately underweight. As I said, we would recalibrate over the next 2 max 3 quarters and change our view there. Amongst the another interesting thing that you ask, any emerging theme or area where we might be getting very positive on the margin or on the incremental side. I would say that would be the new age platform companies or the digital stocks, and I'll tell you
Okay.
why that's happening. See, the interest rates are almost coming to the peak, right? Whether you look at US Fed signals there, the G6, as well as the recent RBI rate pause hike. That's one. The recessionary fears are increasingly, the news around that is expected to taper down. And now, a lot of these companies are talking of paths to profitability, cash flows, talking of long-term fundamental improvement in their balance sheets. I think you could stitch all of that together. There is a case where one can selectively look at these new age platform companies, but again, being mindful of the risks, so have a low exposure here, and definitely keep a 2 to 3 year view, if not more.
Okay, absolutely. Thank you so much, Mr. Arora, for taking the time
Thank you.
out and sharing all these valuable insights with us. And thank you so much.
Pleasure. Thank you, Tanya.
So with that, let's wrap up this episode, and don't forget to follow us on our various social media platforms like Facebook, Twitter, LinkedIn, Instagram. You can share your stock queries, stock feedback, whatever you have. And many thanks for tuning in for now.
If you like the video, do like, comment, share and subscribe.